That's fine. The way that you calculate the housing ratio again is you're going to take the total monthly payment, all inclusive, right, divided by the gross earnings. So in this case, you'd have the mortgage, the property taxes, insurance, and mortgage insurance, and you divide that by the 4,000. So the number you came up with is correct for the housing ratio. Okay. So what does this mean? Why does it matter? Because with a USDA loan, we have to keep an eye on the housing ratio, not just the back end ratio. With an FHA loan, it's more liberal. They don't really look at the front end unless it's a manual underwrite, and it's really, USDA really cares about the front end ratio because it's 100% financing. They don't want the guy's house payment to really be over 29%.
With the 640 score?
Yeah.
640, do you go up to 34.99?
Even then, you want to leave your cushion.
I wouldn't risk it. From what we've seen is that even USDA from even January is even tightened up further. They've even tightened up further. When we talked to the underwriter at Bank of England, she said last month that USDA has even tightened up further. And on
Further
the
than
ratios.
29?
No, no.
Are you talking about 640 plus?
Yeah, 640 plus. Usually you used to be able to get them to 31, 32 on the front end.
Yeah.
She said from what she's seen recently, they're really watching payment shock and reserves. And so, in other words, if you have someone that's maybe living at home rent free at 640, you know, according to her, we'll find out how Gus, whenever we start running it.
Right, because if it's Gus approved eligible, then payment shocks is a non-issue.
No, I mean the underwriter can still
They can still
condition for things if they don't feel comfortable about the loan. So,
so you're saying, what is it now? 31 is what we should be?
no, 29.
No, I'm not talking about 640 plus.
Huh?
You want to still go 29 at 640 plus?
Yeah. So once you get to like 680, then you could probably look at maybe going 31. And this is a rule of thumb. Obviously, you want to run Gus, but
Right.
you know, I want to go over 30. I want to go to 33 unless you had 700 plus credit. You know, whenever I did loan, that's how I always did as a rule of thumb. Now this is just on the fly. You know, because you know, you don't want to get in a situation where you pre-approve the borrower for too much, and you dig a hole with your customer, and they get upset at you because now they can't get the house because you pre-approved them for too high, and Gus won't approve it. So it's always good when you're doing loans to err on the side of caution. The best loan officers give themselves room to be wrong.
You're leaving 2 points, right?
I would at least 2 points, yeah. So in this case, I want to go back to the key point, which is the MCC, what we talked about in the beginning. So we had mentioned earlier, Mark got it right. His total debt ratio is 46%. So that's too high for this house, right? So what do you do in that case when it's too high for this house, John?
See if they're a first-time home buyer for the MCC.
And then what would you do then?
Well, first to see if the state that they're living in is in accordance to the MCC availability, and then you need two pieces of information and to get the MCC how much to add to their assets. Those pieces I'm not sure exactly what they are, but I know the calculations are a percentage of those two combined.
What do you mean?
I just remember going over the math, but I don't remember exactly how to.
Oh, you're getting close. Basically, so what I've been hearing and what you have to be careful of is that so some of the new people, because you don't know, and even some of the experienced people, they'll tell the borrower that they can't go up to 160, it's too much, and they go find another house. So they go and call another loan officer that gets them the loan they want. Okay, so with MCC, generally the way it works, not every state, but in most states, you're going to get a $2,000 tax credit. That's a reduction to the property taxes, like David said. So if it's a $2,000 reduction to the property taxes and the taxes are $2,000, you would basically delete that or subtract that out of the ratio to lower his total, his front end, which would automatically lower his back end too. So if you take out the taxes, let's say that he's buying a Texas and it's a $2,000 tax credit. What's his new debt ratio?
It's gonna drop it by like three.
What's his new housing ratio and his new debt ratio?
Be like 43, 44.
New housing is 22.
What everyone else get. I want to make sure everyone gets the same number.
This is this would have been, well, I mean, it's a little bit higher because I didn't have the mortgage insurance. The mortgage insurance is only $5 a month, right?
Huh?
I mean,
Half a percent.
Half a percent is $5 a month, right?
No, it's like 60.
60?
Times them by half, not 0.05, by half a percent.
Times 0.2.
No, by 0.5. Half a percent. Half a percent.
Yeah. Another monster, man. Okay, so it's 166 plus 800. So his new back end's 42. MCC. 22.
Whatever else get.
Yeah, just keep.
This is his. PI. This one. Actually, no, this is just PI. That's not
Remember, he has $800 in monthly bills on top of that.
This is PITI.
Right, so that would.
And actually, no, I'm sorry. And this is
His original debt ratio without the MCC was 27.4 and 46, you said?
Like 28, 46, yeah.
New back end, I got 43. On the back
still not putting mortgage insurance in there. Give me a second. I need to write down the mortgage insurance. Okay, so
It's like 25 and 43.
I got 23.3 and 43.3.
Sean, you got any numbers yet?
Get them.
And don't no one feel bad about not getting this. That's why we're doing this. We're doing this training because you need to be able to get to a point where you can do this all in your head or with your calculator. So that way you can see things quickly.
What's that?
That's a new office key. What'd you get?
yeah, 22 and 43. I'm rounding.
You got it? Go ahead.
Does that work on the back?
This is the new one.
I have one that just got.
Yeah, that was bad. No. Could you get in with it?
I know.
Yeah.
There's a new one, and this is the new one.
Yep.
3
I tried on the back door today. I was like,
plus.
There's a new
I gave you the other one, right?
the newest of the new.
Is that the key? And you want it.
What happened?
What do we do with the other keys?
I got 48% on the back end.
Okay. And what did you get on the front end?
Front end was 7. Is front end PITI?
Mhm.
Perfect. So
But remember, you have MCC now.
I like Mac, man.
Is he the one that got like a 97 on the test?
Yeah.
Bro?
No, I got a 92.
92? That's a good.
But there wasn't that much math on the test.
No.
Yeah, there's no matter.
Hardly any. If it was the arms.
Okay, so I mean, I have the 763.86, which is the PI, and the TI is obviously 266.67, and that's where I'm at. I don't know what.
Well, okay, so what we mentioned earlier is that because of the tax credit, right? So that's $2,000 that's gonna wipe out.
Okay,
So all you're gonna add is the homeowner's insurance and the mortgage insurance. You're not gonna add the taxes anymore.
Gotcha. So the $80, is that what everyone's getting for the point, a half point on 160,000? It's $80.
I think it's actually $66. Let me see.
Yeah, I got 66.
Do 160,000 times 0.5%,
60 times.
and then divide that by 12%.
Times 0.5. Yeah.
Hit the percent sign.
Okay.
And hit equal. What does that show?
Times 66.6. See, I got $80. So when I thought that, I saw 800. Sorry, 800. I did
Well, that's what it is annually.
annually, right?
So then
that's
you're
why.
gonna divide it by 12.
Exactly. Okay. Divide by 12.
So, but this right here is gonna save you a lot of loans. Because I can tell you right now that house prices are going up, and most of the time for USDA, what you're mostly gonna see is that the buyer wants to buy more than what he qualifies for because the house, the cost of housing has gone up relative to income, and so you need MCC in a lot of cases.
Wow, I just felt like I learned everything now for MCC. So for MCC, you take the tax out, and
No, you don't take the tax out. You take the amount of the tax credit, which is different in each state. Most states are around 2,000. Some states they fluctuate, and whatever that amount is, you deduct that out of the tax.
out of the tax.
In
So
this
it could
case,
be more. There could be still.
well, in this
tax
case, you had it equal
Two.
the same
Gotcha.
amount. Well, if the taxes were 5,000, you still just deduct
3,000
you
left.
still deduct
Gotcha.
2,000. So now this borrower. Now the other question I had, you had a 48% back end. How did you get 48% on the back end?
48%. I took the 763, which is the PI, and then the 266.67, which is the tax and homeowners. The only thing I didn't put was the
close this door,
66. I didn't add the 66 in there, so that's what I'm missing. However, I added the $800 in bills, and I divided that by the 4,000. And that's where I
Do
got
it again
40.
because I don't make sure it comes out to 48%.
Sure,
Do it with the tax credit. Tell me
tax.
what the new debt ratio is.
got it.
So do we have to look and check what MCC requirements are for like each state?
Yes.
I got 47 now.
How did you tell me how you got that?
So I did
Let's
I
just
did
take it
the-
one step at a time.
sure.
You have 800 in bills,
800 in bills.
and how much is the house payment?
House payment 763.86.
Okay. Plus the homeowners is 100.
Plus homeowners is 100.
Plus
and the
66.
tax is 160.
Don't add the taxes.
Oh, don't add the
Remember, we're
taxes.
not doing the taxes now. You're taking the taxes out. Remember, because he has the tax credit.
Oh, okay. I mean, so it doesn't matter back end or front end. It's still the same.
Well, because you're calculating the total back end now. The back end is a combination of the front end and his back end, or total debt. So the back end equals front end plus debt.
Gotcha.
You see?
Right.
So let's add it. You have 800 plus 763 plus 166. What's that? What does that equal?
So the 1,663.86.
You have
No, it wasn't plus, it was plus 100, not 166, right?
166 total, which is the insurance and the MI together
Oh,
combined.
yeah.
Um,
166.
so when Sean, when I said 166, that's the homeowners and mortgage insurance combined.
I got you, right.
Okay, so 800 plus 763 plus 166, how much does that equal?
6. Okay, I got 1730.53.
Okay, divide that by 4,000.
43.
So you see, now the borrower qualifies for the loan, and
Gotcha.
you have a little bit of room, probably. You might need some assets, some reserves, because his ratio is over 41. If it was me doing this loan, I get 2 months reserves on it, because you're really over 41. And if you have 2 months reserves and you have MCC, you probably make it work.
Just once we have access to Gus, then we can have a lot more certainty in the outcome.
Right.
Because then we can do the, it takes a little bit of the guesswork out.
Sure.
Do you need the reserves or not? But by rule of thumb, what he's saying is, ideally, if you're going to exceed those ratios, you need to have something good to go off of to do that.
Right.
Because you have to really know credit very well and the system very well to make that judgment call. So if you go over 29 and 41, we need to, obviously, you guys are, everyone here, if they're doing a pre-qual, is getting management approval first. So we are looking at it, but if you haven't run Gus, you're still going to come to management to look. If you're going to exceed 29 or 41, let's say you're doing it on your own, you still need to make sure that we run it through Gus.
Right. You do run it through Gus. It's just important that you realize the underpinnings of what's going into it to make the decision, Gus. And the other thing is that when you use MCC in Texas, it's a 1% fee. No, it's reduced, right?
That's 1%.
Is it still 1%?
Yeah.
Okay. It's a 1% fee of the loan amount, and that can be you can get concessions to help cover that. And so that's what MCC is. I've heard some of you guys earlier, you're mentioning the borrower doesn't qualify for the loan. I don't think you guys have gone through the MCC analysis to see if you can add that to it. And they do have to, there are some criteria for them to qualify. They can't own a home within the last 3 years, and there is an income cap. And it usually floats around the same as USDA, but I don't think it's always the same amount as USDA. So you have to check with the MCC on their income guidelines because it may be different than USDA. There could be some subtle differences between the MCC cap and the USDA cap.
I did have one earlier, just on that note, you might have heard me saying I didn't qualify. He was at 53 on the back end, 140 loan in Florida.
Okay.
So that wouldn't have, MCC wouldn't have brought him down to.
It wouldn't have brought him down. He can go FHA.
Or a smaller house.
Well, there was a specific property. It was at Pismo.
There's a few things that you can do in that situation. If you have a 53% on the USDA and you use MCC, what sometimes you can do is you can evaluate the credit report. And let's say that in Florida it's not community property. Let's say he has a $500 car payment. Sometimes the wife will take on that car note.
That's what we were talking about, because he's not married, his girlfriend, it's in his name, she's making the payments, we went through that whole thing about joint borrower and this and that.
Sean, you see that? See, if you got someone that, if they have a car payment that's $500 a month, and they refinance it and put it into the non-purchasing.
Takes it all out.
Yeah. So those are things that you can do.
Where the primary is the co-borrower, and you can prove that that she's making the payments.
Well, no, I'm talking about literally refinancing the loan, taking it out of his name.
Oh, completely taken out.
Yeah, and put it into her name.
Right.
And so people have done that.
I think, like in this case, I mean, if it was in that particular situation, what I would have done differently is that if I know that somebody wants a loan and they may not qualify at 140, but I know that they want one, and they'll probably move forward at some point to get one, whether it's the amount that they actually want or less. If I know that that's there. The fact that they're not going to qualify for 140, they'll probably settle for 120 or 115 or whatever. But if I let that go, if I let that customer go, then I'm going to lose that opportunity. You know what I'm saying? So I would have you know, hey, let's get these documents in and let's see what it seems marginal and your ability to qualify possibly or whatever. At least let's get these documents in and really see where you're at, okay? Because it's too much. It's too hard of a call to make in that initial call. Everything's verbal, you know, and there could be something on their documents. Maybe you catch like maybe the auto loan is $500 a month and there's still less than 10 payments. On a USDA loan, you could have now omit it.
Right.
You know what I'm saying?
Yeah.
So once you get those documents in, then you can kind of see, and that happens all the time. But if it's marginal, don't just shoot them off and just kind of say, let's get these documents in, and then let's see if we can come up with a plan from there, because then I can really see what to do next. You can't really see that just talking to them on the phone. You know what I'm saying? Unless it's a complete garbage
the
deal.
way that you want to do that is you want to prepare a few different options for the borrower. You never just want to tell the borrower no, they can't get that loan. You're going to say, here's the options. You're going to come back as a certified mortgage professional and give them the options. Okay, and how I would do that if that happened to me in this case, I'd say, here's your options. What we can do. You can buy the house now, but it's going to require a little money out of pocket, a small investment of 3.5% down. So that's one way we can go. So that'll get you the house. That's what you want. That's the goal. The second option is this car. If we can refinance it and put it into your girl's name, then you can qualify with 0 down. So that's the second option. The third option you can do is you can still do 0 down. You don't have to take the car to your name, and you can buy a house for 110. So you have 3 options. Which one do you want to do? You see, that's how you want to handle that. So, and 50% of the time they're going to pick one of them, and 50% of the time they're going to say, "I'll call you later." But if you just give them one option, like 90% of the time, they're not going to do anything. So again, it's all about probabilities, and if you can get 40% more upside by giving them 3 options, then that's going to increase your yield of how many loans you're going to close. And so it's very, very important that if you give people options, they're most likely going to choose one of them. It's not 100% guaranteed, but it works better than just telling them they can't get that house. It's not what you say, it's how you say it.
Right.
You're telling them the same thing, but your delivery is way different. And so use the MCC. I use it all the time. 25% of my loans probably had MCC on it. Because again, a guy wants to buy a house in Sarasota for $250. He makes $4,000 a month. That's what you're seeing all over the country right now. And wages haven't risen to the same as home prices. So you need MCC, you know, or they need to go FHA.
Yeah.
You're not seeing houses anymore for 120, 110. That's gone, unless it's a pre-existing old home. Builders can't build a house for 110.
No more. Yeah.
So go look. All the builders are building. They're starting at 180, 200, and that's just like a regular basic home. You know, and so even here in Texas, LGI starts like 160 for a 1,200 square foot house. 180, what is it? 1,300 square foot house for 180?
Yeah, and then they appraise out for like 20,000 less, and somehow the deal still happens. I don't know. Was that like $200 a foot?
No, it's not that bad, but it's going to increase your probability of getting more loans in, guys. So use MCC. In Florida, the MCC is only $500.
Oh, really?
Yeah.
Yeah,
The cost.
it's a lot cheaper.
And they still get the same amount of tax credit. And the taxes are cheaper in Florida than in Texas. So some places they are high, yeah.
And like Sean had, this is an example, like Sean has a deal, and like he was talking, he's got docs in on it. And I was like, how much he makes right now? I was like, no, I just want to kind of get things going. And so he's got a lot of the guys' docs in, which is good. It's you're bringing it in because that's what you really need in order to lock the customer in and really see what you have, you know, and then kind of go from there. It's not like if you're doing that, you're going to increase your conversion on that, like the guy in Florida with 53%, but there's a loan there,
Right.
you know,
Yeah.
and but that's, you know, whether or not there's a loan here or not, you know, I don't know.
But we give them options though.
Yeah,
I mean,
exactly.
If anything, we give them options. I mean,
But at least you can really see, you know, what you have instead of just shooting it off before you even know. Maybe there was a stick of gold right there, and you just, you know, that kind of thing.
Yeah. That's the next thing I want to talk about is so a lot of times when you pull credit, you'll see under the you know, Equifax, Experian, TransUnion, it says lack of revolving, and it shows their score and has a little code by it. Does everyone know what that means?
Lack of revolving. Would that be something that they need more trade lines?
Yeah, I mean, so like let's say that the guy's got a 598 credit, and you look at his credit report. He has a few medical collections, and you see he has no open accounts, and you see there's 002 TransUnion, lack of revolving credit. Okay, so in that case, there's no reason to run a rescore on that. You can see it right there what the problem is. So he needs to open up a credit card. He needs to open up some revolving. Now, usually an installment loan will not help this situation. Like a payday loan or a car loan, it doesn't really help. They want a revolving open. And
Well, revolving is
open end, right?
much quicker anyway.
Yeah.
Yeah, so there's a few things that you can do in that case. So how I would handle that, and you had this with your borrower yesterday, is I would tell the person, I would assume that they already added the revolving account and let them know what they're eligible for with that. So I'd say, look, you know, here's the plan. Based on what I'm seeing here with your debt ratio, you're eligible for 140, and so, but this is what we need to do to get you the loan. There's a few different options. So I noticed that you're married and your wife has this Chase card. Why aren't you on this card with her? I mean, I don't know. She has a $5,000 limit. Why aren't you on the card with her? Because if we can add you to that card, your credit score is going to jump up 40 points.
It's also increase the debt too, right?
Yeah. Well, the payment's probably going to be, yeah. I mean, whatever the payment is going to add to that too. But usually revolving has a small payment. You have to keep. It has to be a positive trade line, meaning in good standing, and you don't want to affect the debt ratio too much. But like, you know, I have credit cards that my wife is not on, and probably some other people have that situation too. So, but what happens is that they don't have access to the card. They're just an authorized user. So with USDA, the guidelines are that whoever's going to occupy the home with the primary borrower or the spouse can be added as an authorized user, and still you can use GUS approval with that. So in other words, let's say that the grandmother's going to live in the house with the son or the grandson. And they're going to USDA.
My grandmother.
Huh?
My grandmother.
Only spouse.
Spouse.
Even if they're living in the
She
house.
has to be on the. She would have to be on the loan.
That's what I'm saying. I said she's going to be living in the house with him. So if the grandmother is going to be living in the house with the grandson, or if it's going to be the mother and the son living in the home together,
right,
and the mom wants to add the son to her credit card to boost his score up, then you can do that, and it's not going to be a manual underwrite. So you don't need to go and open up an account at First Progress. This is much faster to do the authorized user because it already has credit history. You see?
The key thing is that, like what he's saying is that you have to have the authorized user account. It would have to be the spouse or someone else. It could be anyone, as long as the other person's on the loan with that borrower. So obviously, if the grandmother's going to be living in the house and she's going to be on the loan, then you can use her.
Yes, but if she's not going to be living in the house and it's the grandmother, then it's a manual underwrite. Okay.
A quick question on the USDA. If anyone's over the working age, no matter if they're working or not, we still need to pull
What
in
do you mean
their
working age?
Like say if a person has an 18-year-old son that lives with them, eligible to work, they have to show their W-2s and all that stuff as well, since even if they don't have a job.
No, if they don't have a job, they just write a letter saying, I'm not currently working or seeking employment in the near future.
Okay, so anyone over the working age, which is 16 in Texas or whatnot, you have to have some sort of either work or a letter saying they do not provide income or they don't. Okay.
Correct.
Perfect.
Yep.
That's all I needed to know. I didn't know that.
Can we get that up front?
If they do,
If they do work, I
you
would.
need income
Yeah.
tax, yeah.
Oh, yeah.
So is it essential
That
to
could throw you
ask,
off the cap.
obviously ages right up front?
Okay,
because if not,
yes. Keep in mind, guys, that on USDA, that's total household income, whether you're going on the loan or not.
everyone, yeah.
So I've had many deals bust out where the little son was working at the grocery store making $8 an hour, and he came out of nowhere. And so
He came out of nowhere?
You
No,
got
I mean,
$10.99 babysitting money.
No, all of a sudden, like if they have a son and he's making money, and I mean, we made all the way to the end, and had to go FHA. You know, because
Well, the other thing too is that, if you have a kid that old, the one of the things I always ask is to the person I'm on the phone with, the applicant, is that, okay, you have a 20-year-old living in the house working with you right now, but you know, that their income, excuse me, ma'am, I'm sorry, but I just want to let you know that their income is going to affect your household income because there's a cap on the total household. So if he's going to be living in a new house with you, then we're going to need his income documents, and that could disqualify you from the program. So let me ask you this now that I've said that, is he going to live in the house with you, at the new house?
Not now.
No. Yeah! Let's do it!
Well, I mean, that's up to them. That's their choice. And if they're not gonna live in the home, or if the son no longer works, that's up to them. They're gonna sign those forms. And so, you know, the other thing is that if they say that he is gonna live in the house, then the other option is that if they truly are over the income cap, then the 3.5% down option is a phenomenal program and very low interest rates right now, and you go that way. So, so the takeaway though is that if you see someone with a 590, 600, 610 credit, you need to still assume the sale of the loan and either do a secure credit card or an authorized user and move forward with the loan. You don't say, I can't help you, and if they ask for a pre-approval, you cannot give a pre-approval letter right now. It's contingent upon them completing this requirement. And once they complete it and it's successfully upgraded on their credit, then you can give them a pre-approval letter.
Can you
Okay.
switch programs,
Yes, you can.
but during contract? Like
Yeah.
when they're under
Yep.
contract?
Yeah. So let me give you a perspective on the number of applications that someone may have, like docs in on, and the number of pre-approvals. Like, for example, Kevin has like 25 or whatever. He may have had 6 or 8 pre-approvals that he may have issued off of that, and the rest are maybe working to get to that point. So the thing is that he's the most successful loan officer here as far as production, and he understands the value of bringing them, having, if it looks like a viable deal, let's get the docs in and see if we can make something happen, whether it's FHA, USDA, or whatever. You know, I had a loan that called in on the sales queue today. It's a $200,000 loan in Bernie, by San Antonio, and they want to buy the house that they're living in. And the husband's been at the same place for 20 years. They have $100,000 in assets, 700 credit score. So they were requiring about USDA. So, and I know the guy was making like $4,500 a month in income, and the debts looked like about $2,000 or whatever a month. So it looked a little high for USDA for debt ratio. So I was like, okay, well, you know, they were like, hey, we got pre-approved for an FHA loan. We wanted USDA. I said, okay, well, this is the deal. It looks a little tight on the debt ratio. So everything else looks great. You're buying in an eligible area. Your credit score is good. Income's good. Stable. And let's go ahead. I'm going to give you this list of documents, and then we're going to go ahead and move forward from here. Now, what I've just done is, you know, locked out the lender that they may have been talking to. And I was like, okay, if you have to put a down payment, are you willing to do that? They said, yeah. I said, okay. But there's a $200,000 deal. And if I just looked at it as from the, you know, they wanted USDA, and I told them, like, your debt ratio is too high, you know, I'm throwing that deal in the trash. The possibility of me converting that deal is gone. And I know that because they have good income or stable income, I know I can make something happen with that. I know I can make a loan there. I just need to get my hands on the documents, take a look at it, the credit, and see how to structure that deal. See what I'm saying?
Yeah. So the key thing is utilize that. I've seen more times than I can count where another lender had loans, and we added an authorized user or a secure card to pop the guy's score up and close the deal. I mean, hundreds of times. So the key thing though is the most important thing is you have to believe that that you can do it. Okay, that there's a possibility.
How long does authorized user take to reflect?
Probably a month.
Month, 30 days?
Yeah.
That's not far.
If you started something in the middle of a month,
It's gonna be 6 weeks.
no. If you start something like in the middle, by the 15th, usually it will be reflected at the first Monday of the next month. That's usually the deadline. So you have from the 1st to the 15th of a month to have a great or high possibility that by the 1st of like April, from 3/1 to 3/15, if whatever they do to their credit, if they do it then the first Monday of April, it should be updated on that report. So you would just pull it. It's about 3 or 4 weeks. You know, it depends on when they do it. But if they do it after the 15th, the odds become May 1st that will be updated. So you want to, if there's like right now is a good time if you're talking to somebody. Let's go ahead and get this knocked out now before it gets too late, too much time passes. Because if you do this later on at the end of the month, you're gonna have to wait another month.
Right.
Do it now. Go open the secured card now. Don't do it 2 weeks from now. And if you want me to do your loan, I need to know you're committed to make that happen. Otherwise, we can't do business together. Right? Sorry?
This is okay. This is a very important thing. Keep in mind because it's gonna all these things we're talking about. It's gonna add up to extra, loans every month for you. Okay, if you're looking for, like I've said in many videos and 100 times that 50% of the loans that I close were not loans when they came to me. So think about that very carefully. If you're thinking that when someone applies that it's just going to fit everything in the box, you're way off the mark, way off. And you're only going to close a few loans a month. To close 10 loans a month, you're going to have to turn half of those into loans. And it's usually simple stuff. I'm not talking about taking a 480 credit to 650. I'm talking about taking a 580 to 640, do a little polish, get some of this stuff cleaned up, stuff like that. So you need to really think about that. Not everyone applies, knows about credit, and they're not going to have a 680 when they call. Now, can they get the 680 in a month? Yes. It's very simple to do, or 640, whatever it is. So you need to really stop and think about that. People are not going to fit the box right when they apply for a loan. There's ideas and tips and things that they can do. Pay down a card, refinance. I've had people, they've had a 12% interest rate on a car, refinance it to 2%, drop the payment $200 to get the loan. I mean, there's so many things. You have to stop and think and look at see what you're looking at and see if you can make a deal out of it. We talked about there was a guy that had the business and he closed his business, so he didn't have to have the loss hit him against his debt ratio. And so if he closes and dissolves his company, or it's been dissolved, and he can show you evidence of that, then you shouldn't have to include that loss into his debt ratio. You want to verify that with the underwriter, but most fair underwriters would accept that. So
that's what I was talking about with David today, like the guy that had unreimbursed expenses for $21,000. But he recently switched the job. Tell him that he recently switched the job as long as the company can provide an evidence or the company can write down on the letterhead that says that he switched the job and there wouldn't be any unreimbursed expenses for that. So you may not count it against him.
If you switch jobs?
Yeah.
Yes. Yeah, if you switch the job, yes.
Or switch the position,
No, that's what, yeah.
Or the promotion or something like that.
Yeah.
Just in case.
You still want to verify with an underwriter, but
Yeah,
let's say that we have seen that before. I mean, it is possible. In other words, let's say that, okay, let's just say, for example, that you work as a truck driver for a company, and then you have $30,000 in expenses to do your job, right? You pay for gas, you pay for clothing, you pay for lodging, and then you get promoted to office manager at the same company. Now you work inside the office every single day, and you don't have those expenses anymore, whether you were the same company, but on your 2014 return you had 30,000 unreimbursed expenses, and in 2015 you're now the office manager. Well, a lot of rookie LOs, they're going to take that 30,000 unreimbursed, and they're going to hit him against his debt ratio. I think he doesn't qualify for the loan. They're not going to. Huh?
But it was more.
Right. That's why you have to have like a forensic type analysis when you're looking at this stuff to really understand what you're looking at. Okay. So he's told you he's an office manager because the pay looks different. You say, how come over here you got paid by the mile and now you have a salary? That's already going to tell you, hey, I need to think about this. There's something going on there.
Right.
So the thing is, he doesn't have unreimbursed anymore. So you want to check with the underwriter to make sure that's okay. Check with your manager, and if you get the green light from both of them, and then you want to issue a pre-approval letter. Do not take matters into your own hands and think, oh, it's okay. I'm just going to issue an approval letter. I need to check first. Most likely it'll be okay, but they're probably going to want a letter from that company on the corporation's letterhead stating that he no longer is a truck driver, he no longer has unreimbursed expenses, and that he's an office manager that receives a salary. Okay? So, and they may want a 2015 return in addition to that showing that he doesn't have unreimbursed. Most likely they're going to want a 2015 return. So,
when we were talking about cost of MCC, I know that's going to require them to have some cash to close, right?
no, if it depends. I mean, if it's a small loan, probably. But if it's a bigger loan, you can get concessions if the house has equity.
If you're using MCC, you're just planning, it's part of how you structure the deal, and that's on you. So it's, if I'm gonna have MCC, since in Texas, $150,000 loan, I'm gonna ask for an extra point in concessions or price their loan out to have an extra point in credit from their interest rate to cover that additional cost. So no, it doesn't necessarily mean that they're gonna have to bring funds to close.
Now, if they have a
But if you don't
$60,000
properly
loan,
structure the loan, yeah.
if it's a small little loan like 60 or 80,
Because your 6% doesn't even cover it to begin with.
they may.
Because it's $600 with a $60,000 deal.
Yeah,
It's not much.
but the credit from the rate's gonna be the same. I mean, it's a little amount from the credit too. So you're gonna have to look at it and see. I wouldn't say that's always the case. It could be. So
Yeah, it's up to you to how you structure the deal. It's up to the law how that if the law structures it right, it would probably not really they wouldn't even notice it.
Josh, if we give them like options and stuff on how to fix things, let's say they're not ready right now, whether it's with credit, yeah, most of the time with credit, can we have like an option in Velocify to just from app docs in to app needs work instead of nurture if they denied, like currently?
Oh yeah, there's not an app. You can't go to app needs work.
No.
That'd be a good one.
Yeah, no, that's where it should go. Is app needs work.
Yeah, it's going to nurture if I put denied, because that's the only one I can do, denied or
Have you
withdrawn.
moved any already?
Just one right now is probably going to take him like a month, maybe 2 months to get his credit out.
Issues needs work. That doesn't have that.
okay, the other thing I want to talk about.
If you go to issue needs work, that's where it goes. The app needs work.
Oh, it has issues need work?
Is that in there? And are you in app stocks in right now? Yeah, he is, and it has one that says issue
Needs work?
issues needs work.
Okay, my bad. I'll just
It's okay. It's okay, David. It's all right. You're new.
Okay, the other thing I want to talk about, it seems like there's a lot of confusion between manufactured homes and modular homes, and so I want to just clarify what the differences are, because there is big differences between them and how we products that are available, what we can do, what we can't do with this. So a modular home is a single family home. Okay, it's built in a facility and it's delivered to the property and it's put on a permanent foundation. It cannot be moved once it's put on the foundation.
Solid.
Yeah, solid. Okay, so the pricing is the same. The interest rate is the interest rate. The requirements, whether it's USDA or FHA, it's considered a single family residence. Okay, but a manufactured home or a mobile home is not the same thing as a modular home. Okay, so with a manufactured home or a mobile home, the minimum loan amount that we can do is $150,000. Okay, and in its name, its definition, it's mobile. You know, it has different production standards, the way it's manufactured. Sometimes it's put on pier and beam. It can be put on a permanent foundation, but even if it's put on a permanent foundation, it does not make it modular.
Still, yeah.
Okay, some people think that some realtors, either by their own ignorance or by deception, will try to call it a modular home because it's on a permanent foundation. It's not a modular home. If it has HUD tags on it, it's most likely not a modular home. It was most likely a mobile home that's been put on a permanent foundation.
About an appraisal.
But you don't even want to get, if you got to that
I'm
point.
saying if there was deception.
Yes. Well,
That would come
but the thing is that you need to know before you give that customer an approval letter. You need to do your darndest. Call an appraiser, call somebody, call the county tax assessor, go look it up to find out. Because if they put a contract that they pay for an appraisal, they're going to come back and blame you. Because now you can't do the loan because it's a $90,000 mobile home and not a modular. 90% of the time, most of the time it's manufactured mobile. 10% of the time it's modular. You don't see as much modular.
You're saying when they're calling about modular?
Yes, yes.
It's not actually modular most of the time.
Most of the time it's not. That doesn't mean that's always the case, but
So there's no modular home parks, right?
there could be a subdivision of modular homes.
Sure.
But they would own the land.
Yes.
They don't.
We can't lend on a mobile home park.
Yeah.
They have to have the whole part of the deal is the land. You see?
Exactly.
So,
that's what makes it real
yeah.
estate.
But we're not gonna do much manufacturing.
No, we don't, and don't even
How
try
much
to.
manufacturing?
No, don't even try to mess with it. But the point is that. But here's what I'm getting at. Here's where my concern is at. In some of these states, like where I've seen them, like in the Keys, there's $400,000 modular homes down there.
Yeah.
Okay, I've had people calling in Virginia, 350,000 Clayton Home modulars.
Oh, yeah.
Okay, and you're telling the guy I can't do it because you think it's mobile or whatever, and that's not the case.
Well, if it's 350, doesn't matter anyway.
But I know, but I'm just saying that if you or you think that you have to go FHA, and you can go USDA because it's modular.
Because it's modular.
So in some of these areas where the cost of living is really high, builders have gotten creative and they're using mobile and modular homes to make the cost of living more affordable. And you may talk to people. I mean, you're talking to people all over the country, man. Massachusetts, all these places, and so, and some of them are actual modular homes. And so you need to find out, because we can lend on a modular home just like a single family. So just keep that in mind, that they're not the same. And I sent you a write-up on it, and it has a lot of good information. Keep that in your folder, and always reference that, because you really you have to become a master at the guidelines and this product knowledge. Because if you don't know this stuff, there's no way you're going to be able to pluck out these loans. You're going to miss a lot of stuff. There's so much opportunity that's presented in front of you, but your eyes haven't been trained, your brain hasn't been trained to see it. And so I'm trying to pass this information on to you, so when you see it, you'll have product awareness or opportunity awareness to grab it and take it. You know, you don't want to pass up loans. You don't need 200 leads to close 2 loans. With 200 leads, you can close 15 to 20 loans. The business is there, but if you don't know what you're looking at, then you're never going to get it. So it's knowing all these little tiny nuances that are going to, it's not going to be that you're going to close 10 loans a month and the customer just says, yes, let's go. Half these loans you're going to close, you're going to have to figure some stuff out. I'm just telling you. So
So is the HUD tag the telltale if it's going to be between a modular and a manufacturer, really? If they don't know, you can it does have a HUD tag on it? Ask
Yeah.
them.
On the outside of the property, if it has this, like a license plate, basically.
Yeah.
Yeah, it's say single wide, double wide.
Got it, yeah.
But the terminology for modular and mobile, they mean the same thing, and that they've gone away from mobile and started using the word manufactured. So it can kind of be confusing when you're saying it needs to be modular, because it's also technically manufactured.
It is, yeah, it's made
Right.
off-site, assemble on.
Right, so it's brought to, and I always, when I talk to borrowers, it comes in pieces, and you put it together like a Lego set or something, or a log, whatever the log, built Lincoln logs. So the mobile home comes in 1 or 2 pieces, and then it's brought and just set down.
Yeah, it says each home is segmented with a home and labeled with a red tag that is manufacturer guaranteed from HUD.
Yep, that's a HUD tag.
Cool.
yeah. So just understanding that is really important, and it may be worth it to do it. I mean, you were talking, you had a $200,000 one in Seattle.
Yeah.
I'd probably do it if it was mobile.
Yeah.
That's worth my time.
But he can't do it in a mobile home park.
No.
Because there's no land to
Yeah.
buy, right?
Yeah.
You can't even have a house in a mobile home park, like a regular house if it's a mobile home park neighborhood.
Zoning.
Yeah, well, I think just it's bad for resale.
Right.
No, lenders don't want
Oh, the house, yeah,
And
you're gonna foreclose on it, and you're gonna sit on that house.
could
for
you
a long
talk
time.
about the land and construction and the new construction stuff? I know we talked about
Yeah,
it before, but kind of just go
Like,
over
what about it though?
like one-time close and
Yeah, the thing on those though, I'm gonna tell you, try your best to stay away from construction loans and mobile homes. Just try your best to do that. You don't really want to mess with that too much.
They gotta bring
Now here's unless on the mobile homes are big loan amounts, then I would do them. If you're talking about a $300,000 or $400,000 loan amount, I would say that'd be okay, but don't spend too much time on the one-time closes. I was telling this to Mark the other day. I've probably seen 1,000 of them in front of me, and none of them closed.
really.
Because in the end, there's something always bust. I was talking to even RC when we were with American Southwest. I mean, they do hundreds of millions of dollars in loans every month, and he's only closed 1.
Wow.
So all the dynamics have to be there, but I don't want to put a bad taste in your mouth. If the customer's committed and the builder's committed, then that's fine. But they have to do the work, not you. Once they do all the work, and then go ahead and process it.
Yeah.
So the builder has to send in his financials. He has to have proof of insurance. He has to send a cost budget. There has to be blueprints. Don't spend an hour talking about a construction loan until you have all of that. You say, here's the video, and I'm going to explain it to you in 10 minutes what a construction loan is. then give me all these things, and then we're gonna talk. And then I'm gonna send it up. Don't spend an hour on that, and then you don't get anything. You just wasted your time.
Yeah.
So, and then it can work. Yes, it can work. But I sent you guys a PDF on it, and I would encourage you to read that. What I would do in a case like that is I would pre-approve the borrower and put them in touch with Christina to go look for new homes. And also have them find a builder that would build the house on the builder's credit line, and then we give them the permanent mortgage. I'll tell them that's how a construction loan works. Or the other option is, yes, you can do it this way, but then we have to get, the builder has to get it. So there's two approvals. There's the builder approval, and there's the borrower approval. You see, and a lot of times the builder doesn't want to do that. About 70% of the time, the builder is not, because he doesn't want to. His credit gets pulled, right?
Yeah.
The builder's credit gets pulled.
Or at least in my experience.
I think the builder's credit gets pulled too, and they don't want to mess with all that. I'm not saying I'm not trying to put a stigma here, but what I'm telling you is do not waste your time until if you talk to the builder and he says he's going to do it, okay, then you can fish a little bit.
And that's the deal with the woman. I'm still trailing a tax return. I don't even want to really mess with it, get all the docs in, but he's got mock-up sketches, sketches and stuff he sent me, and he's already got a relationship with the builder. So from what it sounds like with him, it's like they try to get financing, and whatever other lender was like, they got to a point they're like, oh, we don't do this, by the way. And they were like, well, they're trying to
No, that's
find
fine.
somebody.
That's fine.
We'll do it,
I
so.
know. Like I said, if they're committed to doing it, then
Yeah, but with most people, yeah, I don't.
Yeah.
If they ask
how you want to do it is you tell them, look, yeah, we'll get you pre-approved, and we'll take you out to go look for new homes. And like I was explaining to Sean the other day, half the time they don't even end up with what they thought they wanted in their head. They find something else. So the takeaway on that is that the borrowers most of the time are not going to end up with what they initially thought. Okay, they're going to call about USDA. What difference does it make if they close with FHA? If they don't qualify for USDA, you still need to take that lead and convert it. So, and so what I'm saying is make the most of what you've been given and close it, man. And so, and on that, I wanted to finish with, we talked about this the other day, and I want to make sure it's clear with everybody. So the way that we pre-approve good credit and marginal credit, there's two different ways that we manage that. Okay, so if you're talking to someone on the phone, I saw this the other day. You guys are still pulling all three bureaus, and they have 590 credit. It doesn't make any sense. You can look at the loan when you see the 600 or 590, and you can tell if there's a loan there or not. You just go down and look at the trade lines. You look at the debt ratio, and you can see if it even makes sense to warrant to pull the other bureaus. So with somebody that when you talk to them on the phone, when they call in and they tell you they have a 580 credit score, you calculate the debt ratio, and then you let them know what they're eligible for. You do not pull any credit on this person yet. Okay, sir, based on what you're telling me, you're eligible for 140, might be able to do a USDA zero down, or might have to come up with a little money out of pocket. The next step is pre-approval. The underwriter requires that we verify your income and your credit, so I need to get these items in. There's no cost to you, and this is part of the process. We have to validate these items, okay? You did the research on the Bank of England, you know who they are, you looked me up, I'm sure you checked out all the positive reviews. So the next step is we got to get you pre-approved. So they send everything in, and then you look at it to verify that it cooperates with what he told you on the phone. Is the income half of what he told you? Does he have 50,000 unreimbursed expenses? I mean, you have to check all this. You haven't even pulled credit yet on this person. So, right? So then after everything checks out, then you just pull one bureau. That's it, just one. Okay? Because you're playing the odds here that there's a 50-50 chance that you don't know really what's going to happen with this loan. So, but you never let the borrower catch on to that, but that's really the reality of it. And so you're trying to make it a loan, but you have to also manage your time very carefully in this situation, because you have new leads coming in, you have calls coming in, it's loud, it's crazy, there's a lot of shit going on. So you have to manage all this. So now, if you take an application on someone, you're on the phone with them, they say, my credit's 760. I've been at the job for 20 years as the principal, and I make 60 grand a year. Okay? And you've gone through it all, and it all makes sense, and he's ready to get pre-approved, then you can go ahead and pull a Experian credit on him. And you see that he's got a 748 credit score. Then you can go ahead and move forward, getting that guy pre-approved, get his documents in, and I would run like fire to get him over to Christina to get him out there to look at houses. So you can lock him in. The key is you want to lock that person in immediately. So you want to see the thing about like the best lenders. When I started at AmeriQuest Mortgage, we closed loans in 12 days. There was no remorse, you know. So there was no time to think about remorse. So take your 12% rate, and here's your cash out, and you refinance it in 2 years. So, and it was true. I mean, think about, look at Gallery Furniture. They delivered that table like an hour after I bought it. I couldn't return it afterwards. So I didn't want to, but so it's just that they're smart. They figured out that, you know, I got to get this damn thing, because you know what? Time kills deals.
Right.
If you're 60, 90 days into it, man, I remember I did a loan. I was doing a loan. It was a great loan. It was a 203K loan, but it was taking like 3 months because we didn't know how to do them at the time. And I got an email from the wife. She says, you know, Ernie just got cancer. Cancel the loan. So that can happen. But if we would have closed it in 30 days, it wouldn't have mattered. And so, so you wanted to move quickly, and so with good credit people, you know, you want to put it all together fast, the transaction, and then get them out there so they're locked in. You don't give them too much time to shop and think and see who they're going to go with. You know, so the key takeaway is when you have someone that has good credit, you're going to pre-approve them right there, and you want to get them locked in. When I say locked in, you want to get them connected with a realtor and out there searching, and have them in their brain think of you and the realtor, and that's it. They're already attached to somebody. Okay.
So if the person calls in, they have a 760, everything looks great. That's what you're talking about. You pull the credit then, but when are you getting those, I guess, pieces of information that you need?
You're requesting it right there and say, I need these things, and I'm going to issue a pre-qualification letter. And is that pre-qualification letter editable?
Yeah, it's a Word document, but it's got, you know, you're not going to really edit much on it.
Well, I was just saying that sometimes what we would put on there is that contingent upon getting these documents within 72 or 90 hours, or this pre-qualification is void.
Got it.
You're going to send like a separate email out, like you're going to say, okay, look, this is this. I'm going to need some. I always say I'm going to need some documents, for like W-2s, pay stubs, that kind of thing. I'm going to send you an email out right now, like a bullet point list of those, and you're still going to want them to work on gathering. We need you to work on gathering these, just to make sure that everything that we've discussed here holds up, and there's not going to be any issues that pop up on your documents that, you know, we don't have time to work out later. And now we'll have time to work on it now. So let's go ahead and work on getting these things in. I'm going to have a realtor contact you that knows the area, knows the loan program. They're going to help get you a list of houses. I'll show you some houses and whatnot, and we'll go from there.
So, yeah, on that note, the other thing that I would put on some approval letters like that is cannot execute contract until I have all pending documents. Right?
Yeah.
So cannot go under contract until I have these items. So you still need to get their documents in, but I'm saying that the sequence and how you handle it is different. Okay? You can't, the reason, and understand why you're doing this, because with someone with lower credit, you don't really know what's going to happen with the loan. You don't know. So you don't want to you don't want to front load too much of your time on those.
Gotcha.
You're basically having all those deals cook on the side, and so you can spend most of the time with your good credit customers. Okay, because you're gonna get a mixed bag of everything. So you can't spend an hour with a 580 credit and then the 3700s pass you by.
Because of the 100 bips and credit we can pull, what would you guys, if you guys were doing it in this market today, what would you say as getting a verbal score from a potential borrower over the phone? Not one of those, well, I'm not really sure, I haven't checked it in 6 months, not one of those where you're not going to pull it. About what level? 640 would you pull Experian on them?
You know, if they told me what their credit was.
Yeah, and then they said, where you know, what's a good barometer to go off of?
Yeah,
if they say 580, you're not going to pull it, right? You said you don't want to get doxed.
No, I would have the borrower pay for it. Yeah,
Can we do that?
Yeah, I think it's a funny sweet.
Pay for the credit card?
Yeah.
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 So other fee that you can have.
Yeah.
I thought it was
Only
free,
fee,
though, but
really.
no.
No,
No, it's the only
Somebody
fee.
told me don't ever do that, don't.
no. If you have any questions about what to do as far as this business, just come ask Josh and I.
Okay.
If don't listen to these other coworkers. So
Yeah, I mean, that's,
well, that's why they're in that position. So.
but I mean, like,
so-
what is a good, to go ahead and,
If they say that if it was me,
Yeah.
if they said their credit was 620 or higher, I'd go ahead and pull Experian. If they
Okay.
told me it was 560,
yeah,
so 600, I'd have them pay for it.
Okay.
Say, look, all you have to do is put your credit card in there, and then I'll even email you the link, and just go
where do we get that
on
link?
Funding Suite.
Just go to Funding Suite,
Yeah.
And you log into it, it's probably inside there.
and there's like a,
We can't run it for them?
You have to run it for them.
Oh, okay.
Yeah.
that's what I'm saying is, can we collect,
You're just getting their credit card information.
we can get credit card information
They
on the
can't
phone.
give it to me
Yeah.
on the phone?
Oh, cause I'm fucking fabulous at that, man, that's,
You didn't know that?
Yeah.
I didn't know that.
Angela, what do we do if you got a
Yeah,
person you really
Angela.
talk about? All right, so they send in the docs. It looks good. Income looks good. You run the credit on one, right? It comes back 590, 600. You pull liabilities into the report. You see that you can make the loan work, but they just need a credit score. You see a better credit score. Do we run all three to see if maybe the other two are higher?
Well, you have to see what's needed to get the score up based on what you're looking at.
Mm.
So is it an authorized user? Is it a secure card? What is it? Is it paying down an account and doing a rescore? So from there, once I knew because each one of those things is going to have a different time cycle, right? An authorized user or secure card is 30 to 30 days. A rescore is 2 weeks.
So if it's a rescore, you want to go ahead and take the risk, run all three because you can change it.
Well, no, not yet. I got to see if the borrower. I would look at the credit and say, okay, I see that the Capital One is maxed out and it's $3,000. So I'll tell the borrower right there, because most of the time you have to pay that down by under 50%,
Yeah.
under 40%. So I say, look, based on what I'm seeing, we can get you the loan, but you have to pay this Capital One down by $2,000. Are you able to do that? And he says, hell no, I ain't got a goddamn penny. Then why would you run a rescore?
Well, not run a rescore. I'm talking about if it looks like you can rescore it, like you said, you look at it, it's only like a $300. He owes $200 on it. It's a $300 credit card, so he's maxed out there. If he pays it down $50, he can get the loan. You see that? Would you go ahead and run the other two credit bureaus?
Not until I found out. Again, I will look at the credit report, and if it was a small one like 300,
Yeah.
and I verified with him and confirmed that he could do it, and I have his documents,
Uh-huh.
then I would pull the other two bureaus, and then do the rescore.
Yeah.
But what I'm looking for is an equal amount of weight of commitment from him to
Okay.
what I'm willing to put out.
I got you.
So I don't want to put out so much money and time if this guy is not really serious about buying a house.
I got you.
So if I verify with him that he's going to pay down the account and I have his docs, I know this guy's serious. He wants to buy a house. Then I will go ahead and pull the other two bureaus and run a rescore.
Okay.
Because you're 100% right that there could be some other stuff that comes back on those other two bureaus that totally changes the deal.
Yeah.
So you definitely want to make sure about that. Now so that's really the key takeaways though on this. I'm gonna send an email out about if it's 560, it's a lot of times. Let's say you use Tyler Gregory, maybe he can get them 620 in a couple months.
It just depends on the nature of the report. I've seen 550s, $250,000 loan, one loan officer denied, and another loan officer took it and said, just pay down these two little cards. And there were little $500 credit cards, and it went up to 620. Close the loan, $250,000 deal. There's two little credit cards are maxed
Like
out.
I told Sean the other day, you said that someone didn't want to talk to you because they didn't know where you are, who you are.
Right.
You guys, you have to get in your head that this is your money on the phone. Don't focus on the fear or any of that stuff. Think about it. That's your money. Think about you talk about $200,000. That's $2,000 for you. I mean that's what motivates me and what I'm going to do with that money. Also helping the person, but don't put your mind on the things that are gonna scare you. Put your mind on things that are gonna, motivate you and excite you. When you put your mind on that, you're gonna get all different types of action come out of you. So move your mind and think about those things, and so that way you can get to where you really want to go.
And
Don't.
if it's about where you're at, where you're, hey, I don't know you, we're an FDIC bank. I'm actually an employee of the bank. We do all of our own in-house underwriting.
Well, and that's
I
what.
work out of the we work out of the Houston Processing Center, Nationwide Processing Center, where we process loans all over the country.
Well, that's one of the person was questioning Sean, and and he's like, I don't see you as a member of the Better Business Bureau, and we are a member of the Better Business Bureau. We have an A+ rating, but what I always told people on that is like, look, we're at a much higher level than the BBB. The feds regulate us. So if you screw up with the BBB, you're just going to get an email. If you screw up with the feds, you're going to jail. So, so
He told him that too. He wouldn't ask you, and they came back. We were like, "What did you say? He's going to jail?"
No, that's well, no, but and then you tell him, look, I'm too pretty to be in jail. You see, I'm gonna send you a picture of me. Here, give me your cell phone number. Let's have a picture and forward it to you. So, no, that you have to break the ice with them, and you have to do that. And every time I do that, it always works. So.
And I got a call with a customer in Florida about a week ago, and she was shopping with different places, whatever. And I was like, hey, let me just tell you right now, your shopping is over. I said, I'm gonna give you the best deal. And I called her today, and she's like, oh, hey, I was like, hey, what's the same? We're gonna send these documents. So I never got the email. I got all these emails from all these banks. Which one were you again? And I was like, no, this is Josh Allen. I talked to you a few days ago about the USDA loan, and she's like, oh yeah. She's like, Josh, you know why I'm going with you? And I was like, why? She's like, because you told me that I didn't need to shop any further. That's why I'm going with you.
Another thing I used to do. Yeah, that's good. Another thing that's a good idea. What I would do is I always had on my phone a picture of my son, and I would just send it over to them.
That's a good one.
It would make them want to do the loan. So,
Family photo.
like, hey, Sean, that picture you sent me today, your son.
Yeah.
Hey,
Go.
before this, see, this is what I need to do. Let's see for him. I need to buy him. Yeah. Yeah. I'm telling you, on your email signature has to be you and him holding a fish. And so, dude, they're gonna feel sorry. They're not gonna shop you. So it works, man. It works. So, ask Josh and Johnny what my website used to be.
Yeah, he used to send out like an email and had him and his wife and his kids in that picture, and it went out to all the customers when a new lead came in or whatever. He sent it out to them.
On the homepage of the website, it was just me and my son. It was. Remember? No, it was Lena. It wasn't my son. It was Lena. That was a long time ago.
Yeah.
So, and it was just her little baby.
A picture of me, my daughter, and one I sent out to customers, and then I remember this one. It was like a $300,000 refinance. The Russian lady. She's like, she opened up the email. She's like, "Oh, it's a beautiful picture, beautiful daughter." You don't think that works? That's gonna hit their emotion, man. Dude, if I was you, I would do it, man. I'm telling you. She was in the loan with me.
Anything that you can do.
Yeah.
That's a. If you have a son or a daughter, man, do it, man.
2 boys.
See, they're not gonna leave you for a quarter. So.
Yeah, I got twins.
Yeah.
Hold up a little sign that says like, "Daddy, please bring home the bacon."
Hey.
Something like that. Make him feel the pain.
Yeah, I know you're laughing, but I really did. I had it for probably 7 years. I had that. Yeah, and not maybe 6, but it really does work. So.
See the video.
Anyway, so understand that on the pre-approval and the good.